Hi, good morning. My name's James Igo. I'm an investment manager at Redmayne Bentley. We are investment managers and wealth managers. We're here today to talk about government bonds, interest rates, some of the changes we've seen in that particular part of the investment world, and some of the opportunities that it's created as well. I'm joined by Laura Hutchison from Forbes Dawson this morning. Laura, this is a subject I'm particularly passionate about, but before we go on, could we hear a little bit about you and your company, if that's okay?
Yeah, thanks for the introduction, James. My name's Laura Hutchinson. I'm a managing partner at Forbes Dawson. We're a tax consultancy firm based in the Northwest, servicing high net worth individuals and their entities, their trusts, their companies, their families, anything connected with them, offering them tax advice. I've been in this field of private client tax now for over 25 years.
Thanks for that, Laura. So in the last 18 months, we've seen interest rates increase quite a bit. In the background, the Bank of England are trying to, I guess, quell inflation in the best way that they can. And the way we think about inflation is the type of things that we spend our money on, whether it's houses or cars or clothes. By raising interest rates, can the Bank of England make it slightly less desirable to borrow money to buy those things? And equally, by having interest rates a little bit higher, can they make it more attractive for savers to keep money at the bank rather than spending it in the open economy? In doing that, the intention is to slow down the price rises and in effect, slow down inflation. With all that being said, interest rates have gone up a significant amount in a very, very short space of time. How has that affected the conversations that you've had with your clients?
There'll be different conversations for different clients. I mean, it depends on their circumstances. The typical entrepreneur who borrows quite heavily to reinvest in the market may be quite challenged in these circumstances, whereas the savers, as you said, will be very happy with the rate of return they're getting on their bank. So really it's different conversations according to circumstances. But what we have been having a few conversations about in terms of tax planning is the effect high interest rates has on the price payable for a bond, a government bond. And that's useful to us because government bonds are an unusual investment because they are exempt from capital gains tax. Any gain realised on the sale will be completely exempt from capital gains tax. So when we're talking about high interest rates, the effect that has on the price that you pay for a government bond, typically it discounts that price. So that means that when the government eventually returns that money to you, the full par value, you've made a gain on that particular investment. And as that gain's exempt from capital gains tax, that offers tax-free growth for certain investors with certain circumstances. And I must caveat that to say that I'm only here to offer tax advice, and I would always say to the client, go and seek professional financial advice specific to your circumstances, because this might not be the right opportunity for you, and obviously you'll get that advice properly based on your relevant circumstances. I expect, James, that you've had quite a lot of interest from your clients in investment in bonds. Is that right?
Yes, it's been a growing part of our conversations with clients over the past couple of years, to the extent that they've wanted a little bit more support in this area, or they've had a growing interest in this area. I guess to begin with, for anybody who's not familiar with the terminology, a government bond could also be referred to as a government gilt. So if you've heard those two things before, that's where they are in effect the same. It's effectively a loan to the UK government, and it can be a loan over 1 month or over 50 years. On the back of that loan, you receive a fixed return, typically paid annually. As Laura's touched upon, there are some tax advantages to the way that particular investment works, and that's one of the reasons why it's become sort of a growing part of our conversation over the last couple of years. It goes without saying that, as with any investment, you could get back less than what you put into it, so it's very important to just make that point known as well.
So how is the current state of the volatility of the stock market affecting the rate of return on government bonds? And does it affect it? And if so, how do you manage that for your clients?
Yeah, it's a good question. So it's definitely been sort of a growing feature of our conversations in the last couple of years. I mean, looking back to 2021, government bonds were returning between 0.5% and 1.5%. So they weren't really popping up on people's radars to a great extent. In 2023, they're returning between 3.5% and 5%. So still quite moderate. However, when you roll in the tax advantages that are applicable to some people depending on their circumstances, and the fact that we would consider this a very low risk investment, it becomes quite compelling. So the way that we think about that is part of a diversified portfolio for clients whose assets we're looking after, where it definitely does have a role to play, or for standalone clients where they have large cash balances either as individuals or corporates at the bank. As you'll know, at the bank, there's an £85,000 cap, which is offered by the Financial Services Protection Scheme. That's subject to change, of course. For people who are less attracted to that concept, government bonds do come into play. When clients talk to us about what they want to achieve from an investment like that, some of what they are telling us is the idea that they can lock in a fixed return for 3 years or 5 years, for instance. That's quite relevant to them given where these rates are at the moment, versus having their money set at a bank, given that if interest rates were to fall, the level of return they'd get as a depositor would also diminish. Again, it goes without saying that if interest rates go higher from here, locking in a return could be considered a disadvantage. So it's always worth taking good professional advice before taking any further steps around this type of concept. That being said, Laura, we've got a general election coming around the corner, so lots of interesting stuff, I'm sure, in your world. How has that affected some of the conversations that you're having with clients and the people that you look after?
Well, the clients certainly don't like uncertainty, and we do have lots of questions from clients about what we expect to happen. Now, we can't speculate. As I said, tax is complicated. It's complicated enough without adding further permutations. All we can do is plan around what we know now. But anything like budgets, general elections, we obviously keep our ears to the ground and react accordingly with any advice that we give to our clients that relates to their circumstances.
That's great. Laura, thanks so much for joining us today. That's been wonderful. Thank you very much.